Hey everyone, it's Vish here from Livewire, and with the Ashes in full swing, we're bringing a bit of cricket to investing. Today, two of Australia's leading issuers are going to build an 11 ETF portfolio that they reckon can smash some serious runs in 2026, mirroring the 11-player structure of a cricket team. I'd firstly like to welcome our captains. We have Marc Jocum from Global X and Jamie Hanna from VanEck. Welcome to both of you.
Thanks, Vish.
Great to have you here. I'm going to quickly explain the rules of the game. Each captain is going to pick 10 ASX-listed ETFs from their respective sides to build a diversified portfolio. And then, because we love a bit of friendly rivalry here at Livewire, the 11th pick will come from the other team. So Marc will pick an ETF that's been issued by VanEck, and likewise Jamie will pick an ETF that's been issued by Global X. For those of you at home, please keep in mind that these portfolios are designed for growth-oriented investors, but don't worry, we have plenty of ideas if you're looking for value, income, and defensive strategies. Gentlemen, are we ready to play some cricket?
I think we are.
Fantastic. Marc, first question to you. So just as a cricket team needs to study the pitch before playing, investors need to read the macro environment. What are the 1 to 2 key signals shaping your view of markets as we head into 2026?
Yeah, it's a great question, Vish, and I think we've inspected the pitch conditions, we've seen a little bit of bounce, we've seen a little bit of green areas as well. Overall, we remain selectively bullish. So we're pretty constructive leading into 2026. A few key things we're looking at leading into the new year. One is it is going to be about growth, but people need to be a bit selective with how they position for growth. Adding a little bit of a quality bias, maybe paying attention to valuations, I think is going to be quite important. The US has continued to lead this year. However, if you look at some of the other broader diversification pieces around other countries starting to take that baton away from the US, we still think the US will be where you want to be for growth, but we are seeing a bit more regional diversification pockets, which is really exciting for us. And not just that, whilst the whole focus has been on artificial intelligence, AI, we do think that the next bottleneck is going to come in AI around the infrastructure play. So whilst it's all been around things like semiconductors and some of the hyperscalers that have done a lot of spending, I think one area that investors need to look at for next year is what's going to be that next leg up in AI. And for us, we feel it's going to be around the infrastructure side, the energy supply side as well. And then whilst all these hyperscalers have been spending at all costs, now it's going to be around accountability. Who's going to be earning the most? So we still are quite constructive leading into 2026, which is why we're calling it a year to be selectively bullish.
Okay, selectively bullish. Same question to you, Jamie.
Look, I think 2026 is going to be an interesting year for everyone. The pitch conditions in particular are a little bit mixed between the two ends. I think what you'll find is the US, a lot of the economic policies are really being analysed in great detail at the moment. They're actually looking to cut rates coming up, and that's leading into next year. So a lot of the policies loosening, starting to grease the wheels, and I think you have to be selectively positive on the US, as we've seen there. But if we look at the other end of the pitch, which is Australia, it's operating a little bit differently to how the US is structured at the moment. We've really created a lot of homegrown inflation here, which is potentially going to raise interest rates early next year, which isn't good for a lot of investors, especially in mortgages and the like. So from our point of view, I think you still need to stay fully invested within the market because there's still lots of opportunities out there and you don't want to miss any of the upside, which is potentially going to feed out of the US. From the Australian point of view, slightly underweight Australia, just from a lot of the local economic factors here that, particularly inflation and potentially rising rates. So if you add that all together, I think you need to be fully invested and with just a target to actually have some defensive plays within the portfolio in case the market does turn.
Okay. You're both captains of your cricket teams. One of the biggest decisions you need to make is player placement. In the same way, investors need to think about how to distribute capital across different asset classes, indices. So Jamie, I'd like to start with you on this one. What are you thinking as far as portfolio construction in 2026 goes, and what themes are you most excited about?
Look, portfolio construction, we're actually looking for this particular discussion, it's more of a growth-oriented one. So this is for people who are actually looking to grow their portfolio, have more than 10-year time horizon, and happy to wear in between losses in market conditions. So that taken into account, we're really looking at quite a growth-oriented portfolio at the moment. We're focusing on some of the large caps, which we still think will continue to push higher during the year. Might not be as strong as what we've seen over 2025 and 2026 coming out of some of the big AI and tech companies, but certainly some of the value-oriented names and quality names should continue to do well. And I think there's going to be pockets of real opportunities for growth coming out of the small cap section of the market. It's been a bit mixed this year compared to some of the tearaways we've seen in the large cap. So we're very focused on that. So if we're looking at a portfolio, we're only probably looking to allocate around 20% to the Australian equity market, and then around roughly 40% into international equities. Then we'll then have a small allocation, 10 to 20% into the fixed income space, focused mainly on Australia because we're focusing on Australian investors, so we're not exposing them to offshore currency movements. And then we'll have a little bit at the bottom in alternatives with a bit of gold and infrastructure.
Okay. Jamie, recruiting quite a number of foreign batsmen. What about you, Marc?
Yeah, I think we're pretty much the same as Jamie and the VanEck team on this one. Our view is to go global and go growth as well. Where we're probably a little bit different is whilst the US has continued to lead, I think that we might see the return of some of the other regional areas that actually will start to see a bit of a broadening out in the market. So a lot of people might be underweight things like emerging markets. We're still quite constructive overall. Things like China, India, and even other areas like Japan, which I'm sure we'll get into a little bit later. So we think it's important to be invested in growth. Again, I mentioned have a valuation discipline because there are some areas in the market that are quite expensive at the moment. And we think that there could be some potential re-rating from a lot of high PE stocks into some of the other areas in the market. And similar to Jamie, again, we're probably a little bit more underweight Australia. A lot of areas in Australia still to be constructive on. We're pretty positive on mining and resources overall. Other areas we feel like a bit more of a defensive play might be a little bit more important, particularly focus on income and particularly focus on valuations, but also having that growth posture. Finally, on the defensive side as well, we do have an allocation. We are more pro-growth, but if you want to protect it against things like currency debasement, there's still a lot of uncertainty around geopolitical tensions. We're coming up to a midterm election in the US as well. So we still feel having a defensive ballast in your portfolio. Gold's been on an absolute tear so far this year. We're still quite constructive and bullish on gold, especially as it's found its support level so far this year, around that $4,200 mark. And also looking at real assets. So Jamie mentioned infrastructure. We're still positive on crypto as another type of real asset. But overall, we still think being growth and being global is the way that most people should be looking at portfolio construction leading into 2026.
Okay, so we've thought about the pitch conditions. We've thought about player placement. Now for the exciting part, let's name our players. So, Marc, I'll kick off with you. What's your top order looking like? These are your aggressive players who are going to deliver some returns.
Yeah, so I think when I was thinking about having an opening batsman pair, you do want someone who's got a little bit of that higher octane side of things. Think of your likes of like your Matty Hayden and things like that. But then you also want a bit more of your defensive player who's a little bit more, gets into the crease and bats out a few balls. So for the first one, we're very bullish on China. Right. So China technology. So this is our Global X China Tech ETF. The ticker code for that is Dragon, DRGN. Really a lot of positive catalysts coming out of China. So a lot of people thought China was uninvestable. A lot of people were a bit concerned around the leveraging in the property market over there. It has materially reduced in terms of its weight to the overall GDP. But the next innovation that's happening in China is really coming from artificial intelligence and technology. So we feel if you want to play China, and this is where I say it's a bit more like Matthew Hayden because they can go through a bit of wild swings as Matthew Hayden used to, but it has been one of the best performing markets so far this year, and there's still a lot of innovation happening within China. You're looking at, in terms of the market cap that's been created from the US companies, we think that China is going to start that next super cycle over there. So that would be my one opening batter. The other one that I would pair it with, which is more likened to a Justin Langer, is Japan. We spoke about Japan before, so this is our Global X Japan TOPIX 100 ETF. It's the newest member of the Global X family, only launched a few weeks ago. Japan's going through a really interesting structural reform at the moment. You've got a very pro-government in there with Takaichi, who's very well supported in Japan, but also from a fiscal perspective, spending a lot of money in the economy as well. They've gone through years and years and decades of deflation. You're starting to see wages inflation over there. Yes, bond yields have risen, but you're starting to see a big focus over there over shareholder return and corporate governance. And I think this is going to be a really interesting change that you're seeing within the Japanese market that could provide that next leg up for next year. So we're very, very constructive on Japan. A lot of innovation happening there. And then we still feel that because you've got two really good opening batsmen over there, we still like the growth side of the portfolio. So we still like our FANG ETF, which is your mega cap tech companies. A lot of people are concerned around the concentration in the mega cap tech companies, but you've got to remember, much like you've got your reserve grades and all these other types of grades in cricket, these mega cap tech companies own hundreds and hundreds of companies as their subsidiaries. So we're very bullish still on US technology. Might be a bit more broadening, but if you're looking for someone to get out to the crease, set the tone very nice and early without swinging for the fences too much, we feel having a nice blend of the US in FANG, Japan in J100, and then finally with China with Dragon as a nice way to open the batting.
Mate, that's a pretty intimidating opening lineup. He's channeling the dragon by Matty Hayden. Jamie, how do you respond? What's your top order looking like?
Yeah, look, I mean, we've mixed up the opening combination. So we're going with number one coming in is our growth, GWTH. Really high growth international equity ETF. It's been outstandingly solid over the past year. It really focuses on companies with high earnings per share, both short and long term. And realistically, it's the high octane. It's the David Warner come out and can blast, or even at the moment, Travis Head is doing particularly well in that position. So it's really to come out of the blocks. It's in form, so I'm expecting more of the same. It really is just developed markets though. But from our point of view and where the market is right now, there isn't a lot of value in the market, but where there is, growth is really taking ahead. The other opening bat we have is QSML, which is our quality international small caps. It's been out of form recently, actually, the past year, but its older brother is also in the team. But to be honest, it's quality small cap, so it's focusing on companies with high return on equity, low debt, and stable year-on-year earnings growth. But because it's focusing on the small cap section of the market, it really is being able to pick up some of those, growth opportunities that are outside of the bigger companies. So a lot of companies that are emerging, that are coming through, that could potentially be some of the bigger companies we're talking about in the coming years, are really sitting in QSML. And from the fact is, they haven't been in favor right now. So, it's cyclical. The PEs of these companies are really good. So they've got the runs on the boards in previous years. So we think it's a bit of a return coming into 2026 that they'll find form again and really start to drive some of the performance. Coming in at number 3, though, is the older brother of QSML. That's QUAL. That's the large cap quality national. And really, it's the captain of our team. It's been around for more than 10 years. The 10-year track record is phenomenal. It's really set the tone for our cricket team over the past 10 years. It's certainly the highest assets under management for us. And one of the key factors of quality is not only it does well in most types of environment, but if there is a pullback, it tends to fall less when markets turn and bounce back faster. So it has a lot of defensive capability to it as well, and that can really aid if markets do take a bit of a turn next year. While we're not expecting that, things can happen within it. So yeah, as I said, similar to QSML, focused on high return on equity, stable year-on-year earnings growth, and low financial leverage. So certainly one of the major plays in our team. But if we go to number 4, which is also one of our, a stalwart of our team, is MVW, which is the Australian Equal Weight ETF. Been around for more than 10 years, really good, solid, long-term record in all conditions, realistically. So what it does is it equally weights the Australian equities. If we take the ASX 200, particularly overweight to the top 10 companies, they make up nearly 50%. A lot of weight into CBA and BHP. So it equally weights about the top 72 companies in Australia. So CBA and BHP have the same weight as like number 60. So it gives a broader sector weight across Australia without the massive overweight into financials and resources. So, and it has a lot of mid caps. So the mid caps are also similar to small caps, bit of growth bias to that. So we're certainly seeing some reasonable performance over the past year, and we think that will continue into 2026.
Okay. The one thing we know about the top order or growth equities is they can be volatile during market calamities. So you need your middle order to stabilize things. Jamie, what does your middle order look like? Where's the value, the consistency, the income coming from?
Well, I think you used the right word. It's VLUE for us, which is our value, our international value ETF. Realistically, it's a bit of a cyclical one, this one. It's in and out of form, but certainly is in form over the past year. Over the last year, value companies have done really well. If we look at value managers, and value is really companies that are, I guess the way the index looks at it is companies that are cheap relative to their peers, and that they have, I guess, good growth prospects going forward, in terms of growth, in terms of their share price. So those types of companies are you wouldn't think doing well in this environment. If we look at the market as a whole, you'd say there's not a lot of value in the market when it's sitting so high. But actually, the way the index has been constructed, it's been able to pick up a lot of the companies that have, I guess, been out of favor and have been taking a lot of flows recently, and the share price has been pushing higher. So it's certainly in form, and I think the value companies will add that extra part to the portfolio. It's only a smaller allocation though, but I think, when it's in form, you want to continue to ride the in-form, batsman. And then if we go one more down for a bit more stability, we'd be chucking in infrastructure, global infrastructure, hedged as well. That's IFRA for us. Realistically, infrastructure is the backbone of a whole, I guess, Western world. And we're talking the utilities companies, the power, the water. Then we're talking things like pipelines, airports. And the amount of spending that the Western world has to spend, we're talking trillions of dollars over the next 10, 20 years, just to maintain a lot of our infrastructure investments. And a lot of the companies who are already in infrastructure, they're really set to benefit from new contracts coming their way. So while it's not going to knock the lights out of some of the growth-oriented ones, it is a solid stalwart. It's going to hold steady and should provide some reasonable growth over the coming years.
Some interesting ideas there to steady the ship in case things get volatile. Marc, what about you? What's your middle order looking like?
Yeah, you said it perfectly. Sometimes you lose a few early wickets in the innings, and you need someone to really come in and anchor the innings, really provide that ballast. And we feel coming in within our middle order is our skipper of the team, which is our GARP ETF, growth at a reasonable price, GARP. What we really like about GARP is the consistency around it. Jamie mentioned before about some factors, whether you're looking at quality, whether you're looking at value, whether you're looking at growth. We like that it's quite hard to actually time these particular factor cycles. Why not own all three in one? That way, you've still got the quality ballast in your portfolio. You're just not dealing with a high valuation, but then you've also got some value companies in the portfolio, but that have decent growth prospects as well. So similar to your middle order, that you might have some aging players, and the Australian market has some aging players in there, we feel that it is important to look at the youth side, but also have that growth tilt as well. We're in a bit of a Goldilocks environment, at least hopefully, here in Australia, but also globally in terms of inflation, even though we have had a hotter print in Australia, hopefully coming down, but also growth being quite strong. And we found that GARP actually tends to outperform in that environment by an average of about 45 basis points each month in that Goldilocks environment. So that would be on the global side, and also GARP has been one of the best performing factors since we launched it in September. We've got a lot of conviction in that strategy that to pair it, coming in at number 5, is the Australian version. So this is the Australian GARP ETF, which trades under the ticker code GRPA. Now, what I really like about that is we've applied the same logic to what we did globally to bring it to the Australian market. Not a lot of growth in Australia, right? When you come into Australia, you think about income, you think about defensive. We think that there is still some pockets of growth. And what I really like about the Aussie GARP ETF, GRPA, is it's materially underweight the banks, right? So it barely has any financials in at the moment, given the limited growth prospects for some of those banks. So you've got positions in things like resources, industrial, consumer, and overall, when you're looking for Australia and you're looking for growth, it's going to be pretty hard to find some of these areas, and for a pretty low fee of 25 basis points, really attractive in this environment. Then on your other side is around income investing. Still incredibly important. Sometimes there's different conditions that happen on the pitch as well, and you need to at least have some defensive capabilities in there. In Australia, because the growth prospect in terms of earnings growth might not be the same as what the global some global companies are in there, we really like the idea of introducing a covered call approach to your portfolio. So this is our Global X S&P ASX 200 covered call ETF. The ticker code for that is AYLD. Why we think that's important in this environment is for people who are looking for income. There's been the maturing of hybrids to happen over the next 5 years. We have seen a rise in government bond yields more recently, but term deposit rates, cash, for people looking for a 4 or 5 handle in front of it in terms of yield, going to be pretty hard in this environment, right? So when you're looking at different conditions on the pitch, for people who are looking to potentially monetize some volatility, especially if volatility does come back to the surface, the great thing about a covered call strategy is that not only does it outperform in sideways markets or downwards markets, but when volatility rises, the premium you get rises as well. So at the moment, it's paying a yield of around about 9 to 10% per annum. Really attractive for a lot of retirees or people who don't really want to worry too much about the upside participation from a capital growth in the market, but are really just looking for steady, reliable income. So that way, at least if you have a bit of a collapse in the top batting order, you at least have that dependable income that can happen over a course of time. And if you look over the last 20, 25 years, the covered call strategy has actually done a little bit better than the broader Australian market, but done so with a lot less risk. So when you're thinking about risk-adjusted returns, really important to consider something like a covered call strategy for your Australian equity portfolio.
Okay, another important consideration in a cricket team or in your portfolio is your tactical call or your all-rounder, something that can chase a specific opportunity down or work well in certain conditions. Who's your all-rounder, Marc?
Yeah, it's also a great thing. We're bullish on two areas in particular. The first is artificial intelligence infrastructure. So this is our AINF ETF, where we spoke about it earlier on, but where we're really bullish on artificial intelligence overall is that next layer, right? So you've got hundreds and hundreds of billions spent on CapEx. And for us, whilst these companies are still going to be driving a lot of the incremental return you're seeing in markets, it doesn't really matter who's actually going to be spending it. It's a matter of where it's going to go. And we feel it's going to be going into the data centers, the cooling systems, the heating systems, but also the power generation that's going to be actually powering this AI revolution. So think of things like copper, like uranium or nuclear. We're still very bullish on that. So for artificial intelligence infrastructure, we feel that that's going to unlock that next bottleneck that I spoke to a little bit earlier. So our AINF ETF has actually been one of the fastest growing thematic ETFs in Australia. It's also been one of the best performing so far, and not trading too expensively as well. So we do like that call in terms of where a lot of the investing is happening within the artificial intelligence space. And again, it's really going to be about earnings resilience and efficiency rather than just who's spending the most money. So have a look to where that next layer is. And for us, looking into 2026, this remains probably one of our top conviction calls in AINF. The other thematic that we're looking at in particular is lithium and battery tech. So ACDC is a ticker code for that, for our ETF. Been very unloved, I have to say. Much like a cricket player who, is been out of form, has been getting out a lot, that has been ACDC. But the good thing is we haven't seen a lot of outflows from that fund, which tells me that, like a good selector, they trust the long-term process within a thematic like this. So if you're thinking about massive megatrends, electrification, EVs, lithium is crucial to that. Where lithium has been a bit of a challenge is there's just been too much supply. So an oversupply has led to lithium miners underperforming, but we have started to see a bit of a rebound because it was all about R&D and investing a hell of a lot of money in building up these capabilities. Now it's going to actually turn towards a bit more about, well, what are we actually going to be earning from this R&D? R&D's been, I guess, halted a little bit more, and now the real focus is on margin expansion, and also you're seeing analyst upgrades for a lot of the lithium miners overall. We feel we've troughed in terms of the lithium price, so there's potential upside going into next year, and you're actually seeing a lot of stimulus, a lot of policies from the likes of China, which is actually quite bullish for lithium overall. So for those who want to trust the selection of investing in long-term thematics, we feel both AI infrastructure and AINF and lithium and battery tech and ACDC are those really cool tactical plays that you want as all-rounders within your cricket team.
ACDC, a potential Andy Simons one day, just rockets. Jamie, what about you? Who's your all-rounder?
Yeah, look, we're only playing one all-rounder in our team this time. We're actually going emerging markets, EMKT. That's a broad-based international emerging market. It's actually multi-factor, which is why I put it in the all-rounder category. So it's a mix of quality, value, low size, and momentum. It's really in form at the moment. It's had a very solid year. It's up over the past year about 28% so far. But really what it has, it's adding diversification to the portfolio because a lot of investment, outside of Australia is generally in developed markets. What really attracts a lot of investors to the multi-factor emerging markets is that unlike developed markets, generally speaking, if the US is doing well, Europe's doing well at the same time, or Australia is getting dragged along with that as well. So the correlation between developed markets is quite high. But when you look into emerging markets, what you'll find is, Brazil could be doing really well at the same time India's in a recession, or China's, booming while Saudi Arabia's, struggling. So the economies don't tie together like they do in the developed world. So as a result, the multi-factor works better because what it does is it's able to utilize the different factors at the same time, whereas in developed world, one factor will across all the markets at the same time. So from that perspective, the emerging market multi-factor, really good all-rounder in this environment, adds the diversification, allows to really utilize the multi-factor approach throughout the different markets. In form, I can't go past it as our solid all-rounder at the moment.
Okay, so lots of aggression in the top order, lots of opportunity in the middle order. Very interesting all-rounders. We need to now protect our totals. So that's the job of the bowlers. Who have you got to protect the total, Jamie?
We have our swing bowler, Sub D. It's our, it's our floating rate subordinated debt fund. is really doing well at the moment. Yield to worst of around 5.15%, A- rated. It's floating rate, so it adjusts based on the underlying interest rates within the country. So it will move around and offer that consistent yield in most conditions. Hence why it's a good defender. With the yield you're getting, the variable interest rate, there's not much more I can say. I think for most people who are looking for a fixed income investment, which is paying at a top premium in terms of the capital stack, it's certainly one. And look, hybrid's been dropped, from the team, and as a result of the old hybrid market being dropped by the selectors, it's certainly been the next favourable one down the list, and hence it's consolidated its position in our top 11.
Okay, so that's maybe your slower pace bowler. You got some quicker ones?
Yeah, we do. We actually have our tearaway fast bowler, which is XGOV. It's a long duration of about 8.98 for Australian government and semi-government bonds. So realistically, at the moment, its yield to worst is around 5.14. But because of the duration complexity of this, it is aggressive. It is aggressive in the current environment. I think Australia is vulnerable to macro shocks. We've seen that during earlier parts of 2025, and as a result, yields can actually move quite fast. And I think at the moment, as a tearaway, as something which really offers, pure Australian government exposure, it's certainly one to think about where the yield is at the moment. And coming into, economic conditions next year, I think it's a good play. It's not a definite, outperformer, but I think it's that aggressive protector in terms of market environment. And I think from a fixed income perspective, we've got the floating rate in there, and I think, a good solid long duration fixed income play is a good mix in a portfolio. And then I think we should chuck in one more, which is NUGG, which is our true blue Australian gold ETF, holds gold bullion, only mined from Australian miners, so born and bred in Australia. It really does well in variable market conditions. So if the pitch is turning a lot or there's a few cracks opening up, I think NUGG, NUGG, can capitalise on that. It certainly can protect the portfolio. We've seen gold have a particularly good run this year, but if market conditions do turn, it's a great defensive, good protector, long-term, inflation hedge. I think there's a lot to be said for an Australian born and bred gold bullion ETF, and look, it's completely redeemable. So if you buy the ETF, you can actually redeem the physical gold straight out of it. And I think, from our point of view, it has a lot of features that some of the other gold and other spinners, I should say, don't have in the market.
It's a miracle if there was such a thing for a bowler, hitting a lot of sixes this year. Marc, same question to you. Who are your bowlers?
Yeah, I think VanEck and Global X are recruiting from the same cricket academy because we've gone for a very similar theme as well for our bowlers. So whilst, the England team, you've got a lot of velocity and a lot of different swing bowlers in Jofra Archer and Marc Wood, we like the idea of having stability. So think your Glenn McGraths, your Scott Bolans, who are just hitting middle and off every single time. And for us, that's the Global X Australia Bank Credit ETF, ticker code BANK, B-A-N-K. Similar to Jamie, we really like the idea that with hybrids rolling off, people are going to be looking for alternative sources of income. We like the idea, instead of owning just subordinated debt, to own the whole capital stack of a bank itself. So think senior bonds, subordinated bonds, but also why not own hybrids until they roll off? So a lot of people rolling off hybrids at the moment have to manage it themselves. Why not benefit until they roll off till 2032? Being able to get that franking credit, and also having that floating rate posture of about 80% is really important, but also have that fixed rate component of 20%, just in case we do see some potential capital gains you might see from changing in interest rate policy as well. Paying a yield just north of a running yield of around about 5 to 5.5%, really attractive in this environment at the moment, and also you're getting it issued from APRA regulated ADIs as well, so really strong credit quality. So that's our dependable bowler over there. And again, sometimes when you're bowling, there could be bouncers, there could be Yorkers. There's so many different variations that could actually happen. So for us, similar to Jamie, we really like the idea of having an investment in gold within 2026. So that's our GOLD ETF, largest gold ETF in Australia, first gold ETF in the world as well, that we launched back in 2003. We're really constructive on gold overall, leading into 2026. There was this parabolic rise that we saw over the last couple of months that probably if anything, led to a bit of a healthy consolidation and a bit of healthy selling. But overall, I feel that with the gold price kind of hovering now at around about $4,100 to $4,200 an ounce, it kind of provides a nice little base layer. And we're still on a view for next year to think about things like debasement, to think about inflation risk coming back, to think about ongoing trade wars. I feel like gold is going to be in a really good environment next year, particularly if we see real yields falling, the US dollar falling, which is quite bullish for gold overall, and also central banks still being able to be that pillar or that backstop. And a lot of central banks still haven't added to their reserves as well, even though there's been a lot of buying from some of the major central banks. So for us, two bowlers that can handle those conditions, both within bank credit for your fixed income side, but also just to have that inflation hedge, we still think it'd be remiss not to think about gold in your portfolio leading in for next year.
Okay. All right, captains, it's time to select the wild card. I'm really excited about this question. Jamie, which Global X ETF belongs in your cricket team?
Yeah, look, we're looking for someone to come in, hit some sixes, and maybe bowl a few express deliveries. Could be a few wides, I'm not sure, but we're going with Semi, which is a semiconductor ETF. Certainly high octane, certainly really has some good, strong structural tailwinds at the moment. Really picked up by the AI boom that's going on at the moment. Look, there could be a pullback slightly in semiconductors, but they're, I guess, the backbone. They're almost like an infrastructure play in a way, even though they're not infrastructure, but everyone uses it. All computers use it, your phone, every smartphone's using some form of chip manufacturer at the moment. The whole ecosystem is large. I don't see that changing. The world is really, whilst AI is taking over, but everything's computerized. Everything requires semiconductors. Everything in the whole world these days is just wanting more and more out of their semiconductors. They want their extra nanometer there. So there's certainly some benefits. It's high octane. It's been doing extremely well, but I think it can continue. Certainly a lot of the growth that's coming in the world is coming out of this whole entire ecosystem. So long may it continue in terms of returns, because it is something that's important to everyone and how we all operate in the world at the moment.
Okay, a growth-oriented wildcard. What about you, Marc? Which VanEck ETF belongs in your team?
Yes, similar to when a captain is selecting their field, they want to be able to move in different places, whether you have a silly mid-on, whether you have a fine leg, whether you have someone deep mid-wicket. So for us, an area that we like from the VanEck side is alpha. So this is the long-short strategy. So what we really like about it is the idea is being able to disrupt active management and to do it for a fraction of the cost. Coming in at a third of what typical long-short strategies are charging, I think is really attractive. Bit of a systematic approach versus kind of an individual stock picking side of things, which we like as well. And overall, I think in an environment, especially when you're trying to select your field, to benefit from both up and down markets, I think is really attractive. So we really like the ingenuity that's come up with VanEck in terms of disrupting that active management. We've done some analysis that shows that if investors in these very expensive actively managed funds rotated into their lower cost ETF counterpart, they'd be saving $4 billion in fees, which is a lot of money. So more money in investors' back pocket. So for those looking for a little bit of that higher octane approach, looking for both long short side, maybe go away from active management, looking at some of the ETF side, which is still, I guess, actively managed in a way, but for a fraction of the cost. So that's the Alpha ETF from VanEck.
Okay, and that concludes our starting 11. Gentlemen, I want to thank you so much for coming in, for your time and putting such deep thought into your portfolios. And the fact you can name each other's ETFs, good sign of industry mateship. Great for investors as well. Keeps it objective. So thank you so much.
Thanks for the opportunity, Vish.
Thanks, Vish. Appreciate it.
No worries. I hope you enjoyed that video. Give it a like, give it a 6, subscribe to our channel and drop your comments in the video, and be sure to click on the link in the description. That'll take you to the Livewire website, and we'll have plenty more information about all the ETFs, the cricket team that our captains nominated today. I'm Vishal Texanani. Have a good 2026.